Once again, thanks a lot for joining this. The purpose of this panel discussion is to give audience some kind of a scope on terms of how banks and fintechs can work together. And we are glad to have a great panel today. We have Mr. R Seshadri, who is the ex-MD and CEO of Karur Vysya Bank. He's also a city banker, spent a lot of time in Citibank. After that, spent a lot of time with a lot of banks in general, as is more of a you can say he has been there, done that. And just before this call, we were talking about how Mr. Shahadri was in City Financial, and it was that so much we have invested at that time in technology and doing good. So thanks, sir, for joining it. We have another panelist in Kashinath Hariharan. Kashinath is a head transaction banking for payments in ICICI Bank. Again, a veteran in banking, spent a lot of time in ICICI. I personally has met Kashinath sir sometimes back while we were trying to work with ICICI, and on KredX platform. We are deeply integrated with ICICI in terms of payment processing. Thanks, Kashinath sir, for joining. We have a third panelist, which is Prasanna Madhyastha. Mr. Prasanna is currently heading the enterprise vertical for KredX. He's also an ex-ICICI banker, spent more than 15 years with ICICI Bank, and for last 4 years he's with KredX. So he is possibly the one person who has worked on both the bank side and the fintech side and understand both the side of it. Thanks, Prasanna, for joining again.
Hey all, good evening. It's a nice evening in Bangalore here. Hope you all are safe and healthy.
Yes, of course. Yeah.
So I will start with a little bit on what's going on in the market, and wanted to get the views of the panelists on it. So we all know we are in a post-COVID world. A lot of things has changed. With social distancing, government also trying to push a lot of things, but at the same time, we have seen how finance ministers has comes to help the MSMEs and the businesses. With even RBI came out and given us a lot of liquidity in the system, and also RBI has given moratoriums for the payments, etc. So just wanted to address. So I will start with my first question. So my first question is that how do you see, and this is first question to Mr. Seshadri, is sir, how do you see the banking structure currently evolving in India, and also how do you foresee this changing or not changing in the post-COVID era?
Thank you, Manish, and thank you very much for having me on today's webinar. It's a very broad question that you ask, and therefore very difficult to answer that in a short period of time in a crisp manner. Let me try and talk to you about what is happening in the Indian banking world today. The Indian banking world is broadly split into two parts. There are the PSU banks and there are the private sector enterprises. Prior to the COVID, pandemic striking us, we had, some sort of problems associated with a few of the private sector institutions. Yes Bank to name one. We had a clutch of cooperative banks that had problems. Then you had an issue with a large mutual fund provider. All of this is making the average Indian customer, let's say the depositor, risk averse. So my view, in my estimation, the deposit growth will now get a little skewed for the present, with more deposits going towards the public sector entities and lesser deposits going towards the private sector entities. And that is not a particularly good situation for us, because much of the credit growth that was happening in the Indian market was being driven by the private sector entities. And the ability of the private sector entities to create value both for their own constituents and for their customers has historically been a little bit higher than the capability of the public sector to do so. So that's one challenge that I see. The other challenge that I foresee is the impact of the 3-month-long hiatus that we've had in our business. The fact that we have now given 6 months of moratorium on payments to a large section of the banking community, how that will impact banking balance sheets is a question that one needs to see. So if you look at it, the public sector institutions were recapitalized. I think when I last saw the number, something like 3 lakh crores in the last 4 or 5 years has been put into the public sector banks. And I think if you go back further, the number may be larger. And their capital levels today are not very high, even after the recapitalization. So, and the government has said that they don't want to put more money into it. So consequently, their ability to take risk will be a little limited. On the private sector side, the capitalization levels are better, but one really doesn't know what the impact of COVID is going to be on the balance sheet. And I suspect that most private sector entities will also require to raise capital. So I think these are the two drivers. One, there's going to be a liquidity problem. I think in the near term, that may go away as people forget about, what happened with Yes Bank and what happened with the large mutual fund and so on and so forth. And maybe normality will return, but that will take time. And in the meanwhile, you have the issues arising from COVID. So to cut a long story short, I think we are going into a challenging period for Indian banking as such. It's not very clear how P&Ls and balance sheets will pan out, 6 months, 9 months down the road. Really, we don't know what is happening till the effect of the moratorium ends, until we have some reads as to how people are paying. So I think it's going to be a period of consolidation. I think risk is going to be something that people are going to look twice, thrice, maybe 4 times over before they take it. I think banking as such will have to start thinking of becoming cost light and infrastructure light. The fact that they have 3 monopolies helps banks to survive. And they will have to work closer with Fintechs. They will have to figure out a method of exploiting their capabilities more as they come out of this. So my apologies for taking a long time, but that's what I think. We are going through a period of very significant change, and as we come out of it, the face of banking will look quite different from what we have today. So let me leave it at that and turn it back to you, Manish. Thank you once again for having me on this program.
Thanks, Mr. Seshadri. Kashi sir, your view, you are still part of, working in the bank, and you may have a more insider view on the moratorium which Mr. Seshadri has spoke about, which is, and I think out of all the lenders, we have only seen Bajaj Finserv coming up with certain kind of estimate on how the moratorium, how many people has opted for moratorium, how is it looking like for them. And their figure is not as bad as what people has thought it could be. So when initially people thought that there will be a lot of people looking for moratorium, in some loans it is, but in some of the loans still the moratorium asked or sought for customers are pretty less. So what's your view on that, sir?
So thanks once again, Manish and the team KredX for getting me here on this call. My pleasure and privilege. Just to start off with, I think I would just carry forward the point which Mr. Seshadri articulated very beautifully. And what he said that most part of it, what Mr. Seshadri said, were also true in the pre-COVID period, and it has got exacerbated hugely during the COVID period. And therefore, it if there was a linear way of predicting, we could have done some kind of a prediction, but the COVID has kind of distorted any kind of prediction of as to what would happen, and rightly so. To call which way it would go would be dangerous. So I think I would like to bucket it as 3 periods of our being, as we may say, with respect to the banking industry. So one was the normal period, which is the pre-COVID period, which beautifully and articulated by Mr. Seshadri. The COVID period, we've seen, suddenly people are, is the abnormal period, as we may say, the normal period, abnormal period. and then we're going to have the new normal. So let me talk about the new normal. And I would like to attempt this not as much from the bank perspective, but from the customer behavior perspective, which will also have implications to the banking side of the story. So we all, have been, perhaps working from home, and we've seen that, over the last 60-day period, most of us have seen our own consumer behaviors dramatically changing. Whether it is, running large, corporations through home, or, consuming pretty less. We were all, discussing in an office chat group of how the credit card bills have literally been zero over the last couple of months. Plus attitude towards what is required and what is profligate spending. Those are taking perhaps a very hard look, and people's outlook towards creation of investment, wealth, etc., etc. Those are those aspects from the customer behavior perspective is going to change dramatically. That's important because it is the pull which will create the demand for loans, and if there are permanent shifts in attitude towards consumption, which is the main driver of the Indian economy, one might see that there would be a muted growth in terms of the asset book, from the consumer lending perspective, and therefore, the credit lending to many of the corporates and so on and so forth. So that's on the consumer side. There is also, as rightly articulated by Mr. Seshadri, there is a huge dearth of banking supply. So normally it's always been the other side. So there's a good banking supply constraint today. There are certain banks and certain things which are reticent towards lending in these environments. So banks are also going to be extremely choosy in kind of giving credit. We will see. So my personal view is that we will see a kind of a contraction, which economists are calling any kind of recession, X, Y, Z, or whatever term you use. Net, the shifting attitudes of the customers towards consumption, the short supply of banking capacity, both put together is what the new normal is all going to be about. How this plays out, it's anybody's guess. Obviously, we can't paint everything with one brush. It's going to have segmental ups and downs. So sectors like entertainment, hospitality, etc. We are already seeing a lot of strain. Yesterday, I was having a conversation with one of my friends in Bangalore. He said that many of the pubs and restaurants in Indranagar area have been kind of permanently shut down, obviously because of labor shortage and also financial issues. So we're going to see a whole new realignment in the new normal, and I think it's a storm. We don't know where the end is. We don't know how to call it. So it's like we have to dig our head into the soil and look at, go back to the fundamental principles of design, why we do what we do. Become leaner, become stronger, cut out anything which is wasteful, in terms of where we can save either effort or cost or non-remunerative line of business. And it is kind of completely into making yourself strong. Once the new normal starts returning, I would tend to think that the market will offer multiple opportunities for those banks and financial institutions which have understood or which have pivoted their business model rather quickly, which would suit to the situation. So no longer can you kind of do your lending and banking in the same way that you are experienced of doing it now. So you would need different kind of credit filters, from a completely changed environment. So I guess the key message here is that the banks and fintech, in this space, have to kind of consolidate right now and go back to the basic. Look at the processes, eliminate the ones that are not yielding result, make it robust, make it lean, and be ready for when the market opens up to kind of fight back. And those that are quickly able to pivot will be the ones who will do it. So in summary, I would say that in the current times, in the bad times, you should be the last one to fall and the the least to fail. And when opportunity comes, you should be the first and the fastest. So I guess that is what will take to be a winner.
Thanks, Kashi sir. It's very informative, and you have pretty much set the tone for the next question. So there's a lot of question, a lot of talk going on on digital banking side. But one of the hindrance of digital banking or going fully completely digital was regulation. So there was flip flop on RBI from eKYC to video KYC to different format, and even like signing of agreements, contracts, e-signing, etc. So, what's your view on that piece in terms of the digital adoption, and mostly the digital adoption more by the regulator rather than the banks? And how do you foresee in a post-COVID? Do you think that it's going to get accelerated much faster than what it is being happening earlier?
Yeah. So, can I take that question?
Sure.
Yeah, so Manish, the way, so let me recount some of our, as we are speaking, we have a transacting experience which is going on. So yes, we have indeed seen a massive increase in the digital adoption, both at the retail customer level as well as the corporate side and the SME side, by usage of the various, online channels of banking, because the branch capacity has been severely restricted by people's restriction to actually go to the office. Yes, we have kind of pivoted our entire business model to be able to service almost everything, let me say, literally everything today as I speak, to be able to kind of deliver all kind of banking services. And that has, actually launched us in good state. And we have seen a lot of business, that we have been chasing for a long time, coming to us and saying, hey, look, why don't you do it for us? And just because we were able to deliver, we were able to pivot within a 3-4, within a week's time, we were able to quickly pivot our business model, whatever was physically possible, whether it is in terms of agreements, escrow, physical signing and stuff like that. So we've been able to quickly pivot our business models and operate completely from from a electronic way of interacting with the customers. Yes, there has been a lot of resistance from customers. We've seen that, but slowly and steadily, we have seen customers coming and adopting to the digital way of transacting and adoption of various digital channels. So I definitely think that the trend is very positive, because people have felt they have many of the fence sitters have crossed the fence and they've kind of started to try, and they've seen the advantages, the speed and the convenience and the frictionless part of the story that they have definitely seen and experienced. Now the key question is that will we see a reversion to the mean when the normalcy happens? Human behavior is pretty strange. We can recount back, say, 2-3 years when the demonetization happened and there was a huge surge in digital, and all of us know that. And once the cash supply came in, and the circulation of physical currency in the economy has grown manifold since demonetization. So yes, it was a jolt. People suddenly took up to a lot of digital means, and we did see overall digital adoption go up, but also cash circulation go up. So the key challenge now is to maintain the momentum, to ensure that this convenience stays, and we don't do reversal of the mean. Customers don't come back to their old practices. Bankers also don't come back to their old practices. Fintech also don't come back to their old practices. So it will take effort of the ecosystem to move in that direction of actually maintaining this for a longer time, so that the digital adoption only grows. But yeah, it's been a very, very positive surprise, I must say, the way customers have responded to the current situation, and so have bankers.
Sure. Say, sir, a question to you.
Can I, before that, Manish, may I add to what Kashi was talking about? I completely agree with what he said so eloquently. I think there is a long-term movement, towards more digital methods of engagement with clients. That doesn't mean that face-to-face will go away, but it will change. What will happen face-to-face will change. So I used to keep asking my folks within KBB, why should a customer come to our branch? Is there anything that he has for which he must come to the branch? And after much thought, they would tell me that he must come to the branch if he wants to operate his locker. That is the only thing for which his presence in the branch is mandatory. Okay. And locker is not bank's normal business. In fact, it is an add-on so that we can pay for the damn strong room. Right? Right?
Yeah.
It's a method of paying for the cost of the strong room. So already the nature of the branch has to change. And, we kept talking to them and saying that, look, he has to come to the branch because he thinks he's getting value. When I say he, it includes the feminine. I mean, I don't want to be perceived as a member of the patriarchy. So it is, he or she will come there if he thinks that some value can be given to him, right? Some advice can be given. And advice can be of two forms, one for individuals and one for businesses. So our people in the branch have to get trained. They must be able to provide value-added services to clients of the future. Right now, banks are operating like operation shops. And they're extraordinarily expensive operation shop, taking some voucher, taking some check, debiting some account, paying out. All of this can happen from home, right? So I think there's going to be a huge change in the way banks perceive themselves, employees within banks perceive themselves, and that will happen over a period of time. It is an unstoppable thing. So within KBB, what we had done was we probably, most people don't know this, but we are fully digital. I mean, KBB was fully digital. All loans are digital, including execution of the contract is digital, even for home loans, auto loans, personal loans. And there was an API gateway with which we could connect to everybody else. So we had an APG API gateway. For instance, the Amazon's Pay Later product is actually financed by KBB, which is an old private sector bank. So what has happened today is that actually people who are moving into this situation later are at an advantage. The more automated institutions are locked in with legacy software solutions, and legacy software is more difficult to deal with than no software at all, because building something new using new technologies is easier, right? So my view is, over a period of time, banks will have a whole host of fintechs with whom they will be doing business, right? And they will provide levers where they aggregate customers and the banks provide the balance sheet. What is a bank? Bank is nothing but a balance sheet, right? And so banks will go back to their traditional role of being providers of balance sheet. Fintechs will provide customers, will provide the engagement model, will provide smarts with respect to how risk is managed. Obviously, they need to be well capitalized, so the banks have to believe them, right? But banks will become more and more balance sheet providers so that fintechs can ride on them. The fact that fintechs cannot take deposits means that they will have to perforce rely on a deposit-taking institution, which is a bank. Sorry, I interrupted you when you were going to ask me a question.
This is very nice, sir. So it's very nice point that you have made. Actually, in a way, you have answered my next question. But I just want to build it up. What I have seen, being part of banking and then coming out of bank and part of fintech, is the way banks assume fintech is more like a competition rather than a collaborator, and fintech also sometimes wants to become more like a competition to banks. So it's very funny that what I generally say is that banks wants to become as agile as fintech, and fintechs are trying to become a bank. So there's what do you think is the best modus operandi for banks or fintechs to collaborate with each other, and or do you think fintechs is just a fad and it will pass away, or do you think that it's a more long-term relationship between the banks and fintechs that will continue?
I think it is a method by which customers can be accessed and particular products and services made available. Okay, which the banks themselves may not be able to do. So the way I see it is that banks over a period of time will come to realize that they are at some level competitors, at some others they are entities with whom you have to collaborate because it is in the mutual interest to do so. Um, uh, by and large, given the size differential between the two, I suspect that there will be a more collaborative existence than a competitive existence. A fintech that wants to become a bank will be neither a bank nor a fintech, and a bank that wants to become a fintech probably will not be able to do it. Though I'm a little surprised by the level of paper that many fintechs use. When I was working with KVB, we used to deal with a whole bunch of these fintechs, and very often we found that some of our processes was more automated than some of theirs. So if you're going to be fintech, then you must live up to those words, and you must have technology that does stuff that is advertised. So I think over a period of time you'll find more and more banks engaging with them. I know for a fact that banks like RBL and banks like Yes actually had done a lot of work with them, and I think ICICI as well, and people like us. So we in KVB we had got 6 or 7 such relationships where we had an API gateway. The guy used to do some typing at his end, and everything would come to our end. We could run our own scorecard and instantaneously say yes or no to a loan, and we could also fund it instantaneously. So all of that is possible technologically, and obviously the fintechs will have to deal with banks who are willing to engage them in that manner. Not everybody will be, but I think more and more you'll find that people will be willing to do that because the world is changing. As Kashi was saying so eloquently, I mean, people's needs are changing, and the way they engage with banks will change. I think fintechs are a mechanism that will enable banks to evolve to meet the needs of customers in the future.
So KredX, sir, when we started, we decided that it will be a completely digital platform. And few of the banks, when we started working with, banks said that, we want to work with KredX because you're a digital platform. At the end of the conversation, they said that, can you get my application form wet signature by the customer? And we said that, but we are digital, right? So we have to be completely digital. But then there is a wet signature on number of application and number of contracts that comes up. So I can totally relate with what you're saying on that front. So Prasanna, this is a question to you, and as you're part of both, fintech and banks, and you have seen, you are in the middle of, you are one of the earlier employees or earlier joining of KredX, and you're also being held so many senior position in banks. So what do you feel is, maybe there's something which banks are missing, or there's something which fintechs are missing? Is there a point, or is there a way they can collaborate much better than what they're doing right now?
Manish, thanks for the question. I hope I'm audible. So basically, it's a journey for me between shifting from bank to fintech company KredX. I would like to put it in a nutshell this way. So basically, banks being heavy on customer base and the kind of hierarchical structure which they have, and the kind of simplicity and agility and the speed and convenience what the fintech brings in, and the eagerness to grow with the kind of innovative ideas, I feel there is a little amount of gap. When I started with KredX, I did meet couple of, in fact, at least 20-25 banks to explain what we do. And then thanks to, in fact, most of the things Kashi and Sheshadri and Manish has already expressed it. But that's that these banks were typically looking at from a curiosity point of view, what is we doing, and from a competitive point of view, that is it this going to sustain? and we're looking at collaborating only to have the best of worlds. So that's the feeling which I used to get. Then over a period of time, things have changed, and I would like to explain why it has changed. So typically, the kind of the challenges which bank has is more, I could understand, is that the kind of security they need to maintain, and the kind of worries they have around security, like tech stack integration, data field matching, API matching. So these are something which their worries are. And apart from the kind of confidence they have in the customer base they hold, and then somewhere we realize that as a fintech companies, along with the idea we bring in, we also have some amount of zeal in our mind, that we want to compete with the banks. However, we say that it is very far away to compete with the banks, but we somewhere in the corner we have that mindset. So I guess it's an activity which at a bank side some amount of mindset to be changed, and the fintech side, company side, some amount of mindset to be changed, and that is where the collaboration can happen. Some data I would like to throw. Digital Fifth, there was an event, and then I was just going through that event, and I was like wondering. So that data said that there are 100 such fintech companies, and I guess it is not 100; it will be more than 1,000 or fintech companies in the market today. But what I wanted to highlight is that there are around across the banking services, whatever products and services they banking system offers, the fintech is present in all measures. And that's just trying to say is that today we have fintech companies who are into banking data management, credit bureau, alternate credit platforms, KYC, and AML and risk management companies. So there are good amount of avenues which these fintechs have figured out, and trying to work on innovative ways to make the customer experience better, and that's what is happening. However, but in fact, to the honest point of view, all the fintech companies has to sit on a banking platform, at least from a banking account operation point of view. Now, the question is that how much bank can work with these fintech companies, making the experience more automated, one. And two, is there a probability that banks can expose their customers and look vice versa? And some of the successes I've seen in the banking exposing or bank getting customers is like, the kind of integration Drip Capital has done, or an Open as a company has done. There's good amount of integration has happened, and we see a lot of synergy there. And as Shri sir said, banks like ICICI, Yes Bank and RBL has shown a great amount of ownership and approach towards this fintech in a true sense of collaboration. However, so there is still amount of inertia from these banking system to see really there can be a long way collaboration or a growth oriented collaboration. That is something I feel we are yet to see, and we will be very happy if that happens, because trust me, there is good amount of value add these fintech companies are bringing in, and collaboration can give a so basically it's an end customer, right? So it's all about satisfying the end customer's need and giving a better experience to the end customer, and that is what every fintech company across avenues is looking at, right? So that is something which I think is going to happen, and we are looking forward for. And second thing is, I was reading an article saying that it is becoming very difficult to monetize these integrations, the tie-ups or the collaborations. So how do we monetize? Like, for example, fintech company feels that they are giving value adds. So is it that they should receive some monetization, or a bank feels that I have a database, should I receive some monetization? So this is one part of another topic where there are a lot of discussion which goes to a dead end because of monetization. So I guess this is my experience, which I have seen with when my colleagues in different fintech companies, and being a banker, the transition of mine from a banking to fintech, and that's what I had to share, Manish.
Very well said.
So if I have to expound on that a little bit, this is very interesting. It is that, let me tell you that banks are the way they are because of what Mr. Seshadri, talked about in terms of their legacy systems. Um, I can assure you that there is no lack of intent or purpose in kind of refining customer experience. It is like, it's a running, it's a difference between a doctor and a mechanic. Why is a doctor so highly paid? Is that, he has to do an operation of a heart and keep the patient alive, and the heart has to keep beating. I mean, that's not the case with the mechanic, and the car is completely dead, and then you kind of replace the engine or a pump or whatever it is. That's a huge world of difference, and that's the problem that we as bankers deal with. Like, how do you bundle the old with the new, right? You can't trade off. The trade-offs are very challenging from an infrastructure IT perspective, and and also the regulation angle is something that is always a big overhang, which from a fintech perspective, I wouldn't say that people throw caution to the winds, but the way in which RBI audits the bank, the severity of that, and the various things that come in are never known to fintechs. Now they will know. Many of the payment service aggregators, etc., they are getting into the the bandwagon of regulation of RBI, and rightly so, because this is what fiduciary responsibilities. So that is what prevents bank from actually jumping into the bandwagon and actually creating the new normal. But I can tell you, hold your breath. This is all changing. Both infrastructurally, banks have realized the power of APIs, as Mr. Seshadri mentioned. There are massive infrastructural changes that are underway across banks, I must say. And, the architecture is getting nimbler, fast-footed. And one is not just talking about, when you talk about collaboration with bank and fintech, oftentimes we refer to, normally it's a lead referral module that, the fintech will kind of source leads and then polish it and transfer it to the bank and so on and so forth. Largely it is, the space that is being talked about is the retail and the MSME kind of thing. That's what it's talking about. But there is a huge space out there, which is, in the absolute B2B, the large corporate space, SME space, and corporate banking space, where huge amount of payment solutions and credit related programs and data analytics and a huge lot of things which are relatively untouched. Now that's an area, if I say positively, where fintechs are technically not working. I mean, you are one of the exceptions, Manish, who's invested, in the periphery of this area and doing a great job. But if you see, this space is rarely populated by fintech. I mean, I don't come across too many fintechs who are core B2B, in terms of their nature, that their customers are large corporates or, stuff like that. So my message would definitely be that we as a bank definitely look forward to deep collaboration with the fintech of all space, more specifically the B2B space, because we do feel there is value in the way fintech work, the intellectual capital that they bring in, the agility that they bring in, etc. And in the B2B space, the challenge is not as much customer acquisition, but more in terms of servicing the demand in a frictionless and a meaningful way. So we as a bank are pretty open, and we've invested big time. In fact, even taken stakes in some companies, which is a part of our annual reports. You can check. So the banks are all making the right move. From a fintech perspective, I would tend to think that fintechs try to solve very narrow problems. I mean, that's the way as a banker I think. There's nothing right or wrong about it. See, banks think of themselves as universal boss. I need to do right from account opening to servicing to post-servicing to recovery to reporting to RBI, and there are hundreds of things that a bank does besides managing the branches and so on and so forth. But fintechs tend to solve the one narrow set of problems which they are good at. So while that's a good thing, the not so good thing around that is that when I want to tie up with a fintech for a particular thing, then the left and the right of it, I have to look for other solutions. So I have to talk to fintech number 2, fintech number 3. Acha, you do this, and then put this whole thing in a basket and starts making sense for me. So then the question arises, boss, if I have to do so much of tie-ups, then why might I not try to do it myself? After all, it is all investments of technology, people, process. It's not the know-how gap. It's more about actually getting down there and executing it. So that's where I think it stands. So I think our bank is pretty welcome in terms of joining hands with multiple fintechs, and this collaboration will exist. The market itself is pretty large, I would tend to think, and there is space for all. I think it's only collaboration that will work.
Very well said, Kashish, very well said. So I move into Shri, sir. So Mr. Seshadri, you are always being a stalwart of technology. You said when KBB we started digitizing the entire bank. I know my experience from City Financials where you spend so much time in making sure that we have a really amazing technology for everything. So is there any innovation which has happened in the banking and financial services, including from banks or fintechs, which is you really think or you really thought is amazing, and this will is something which you have thought that this should have been come earlier, or what are the innovation which have really baffled you, or really said that this is India is moving in the right direction?
A very good question, Manish. Manish, if you remember, when we were in City Financial, we used to have we used to demonstrate how we could write a loan, giving a guy a laptop, a mobile phone, and a motor scooter, right?
Yes.
And in those days, we used to demonstrate it to all those foreigners and feel happy. In India today, you can do it because the information availability, which wasn't there in those days, is there now. There is an information stack that gives you all the information that you need to actually, by and large, write a loan. You have the ability to execute contracts paperlessly. So the Aadhaar based execution of loan docs is possible, which is what KVB does actually for all its home loans, etc. It's a paperless, fingerprint-based authentication based on Aadhaar. So the information stack that is available is really world-class. There aren't very many places in the world where this information is available. The only place where I would think more information is available, it's actually Korea. The difference between India and Korea is that in Korea, when somebody applies for a loan, let's say he wants a personal loan, he comes to the Korea bank website, he authenticates himself. Every Korean has a digital signature, so he authenticates using a digital signature. And then using the digital signature, he gives us access to his income tax records through another website. You can pull the 5 or 6 bureaus that exist. I think there are 5 bureaus in Korea. You can pull all of them, run your scorecard. At the same time, you can actually ping the bank, right? You can, from a bank-to-bank basis, you can ping the bank and say, okay, this bank account number, please tell me who is the holder, right? Is it Manish Kumar with a national ID number of ABCDEFGH? And when everything comes back, right, you now know that that bank account belongs to him. You know his income because you are able to pull his tax records. And then you are able to run his bureau, right? Then, and since you authenticated his bank account, you can actually credit the bank account and be done with it. Right now in India, the only step I can't do is actually authenticating the bank account to which the money is going. So that's the one step that is missing, but everything else is there. So to answer your question, I think the one thing that has happened is information has become available. Technology has become such that it is actually usable. The user experience when you're using the technology is not like what it used to be in the past. In the past, you press the return button and then wait for 50 seconds before the screen slowly refreshes, right? Because the bandwidth was so low or the processing power on the other side was so low that it took a long time for things to come back. So while technically all that you could do today, you could do 10 years ago or 15 years ago. It wasn't really a feasible solution. Today, everything is feasible. I'll give you an example. I opened a broking account the other day, and my experience was spectacular, actually. You know, the way the entire process for opening was handled, the way it was completely paperless. I haven't signed a piece of paper. I've uploaded a few images, but everything is paperless. And the broking account is up and running, and I've started using it. This could not have been possible because without the information stack that we have, what they call India's stack. And it wouldn't have been possible without technology evolving in the way it has. So I think going forward, there is no option. Banks don't have an option. They have to change the way they do business. Like Kashi was saying, and they understand it. And, I think the evolutionary process will only get speeded up because of COVID. Nobody wants to shake hands with anybody. Nobody wants to touch anything that other people have touched. So, perforce, some of the stuff that fintechs can do well, which is doing stuff at a distance, will have to gain traction. Long answer to a short question, Manish.
Sure. Thanks, sir. So, Kashi sir, I mean, before we move to the questions, sir, and there are a lot of questions from the audiences, what's your advice to banks and fintechs?
Well, it's a. I don't know whether I can be in a position to advise banks and fintechs, but I guess I think I would talk about the relationship that banks can perhaps have with fintech and the other way around. I mean, on that part, I will put my comments. As far as fintechs do bring tremendous value to the table. So one must look at all the areas where fintechs can add value, not just in sourcing of the leads. So today, we can talk about multiple collaboration with fintech who are not only assisting us in some kind of NCA, new customer acquisition, but more importantly, we are pivoting the models of fintech in driving customer experience, driving operations. So, for example, we have robotized a huge part of our operations. We have put in bots which are available in most of our channels. We are learning heavily from it as to how to respond to it. And these have all been possible by collaboration with the fintech. So one advice to the fintechs would be to say that when you do approach banks, your value proposition should be very clear, one. And two, you should step into the shoes of the bank and not be riveted in the position of your product. Because see, as a many of us who create products, we tend to get anchored about my own proposition I have created and stuff like that. Whereas that may or may not be the way the world sees it. So it might require you to pivot your business model. It might require you to do pilots. Piloting is a very powerful tool, POC, etc., which I definitely think that whenever fintechs are approaching banks, they must, have this, right away to say that, hey, look, I will do a POC with you, either free of cost or whatever at whatever time it takes. Because you have to understand that, that banks have to see what it does for you. One has a hazy idea in mind. Do a POC, then that hazy idea becomes, slightly more concrete. And then you have to understand there is a process of getting your investment dollars in bank. So then you get hazy idea into a little bit concrete idea and go with that, get your budgets, right? That's a process. One has to be patient for that process. Come back and then do a little bit more, the first step, second step implementation, and go through, to the whole process. So that is one key piece of, my personal experiences of dealing with fintech. I could say that it will hugely benefit both the banks as well as the fintechs.
Thanks, Kazi sir. This is really very valuable. I think
So intrinsically, banks do want to work with fintech. Let me tell you that.
sure. I think
So, Manish,
down the path for anybody, any entrepreneurs or any fintech enthusiasts who are listening right now. I think you pretty much laid down the path of how you want to start and how you want to partner with banks. So thanks a lot for that. I think people should definitely listen to that what you have said in terms of the partnership with banks. So we are coming to the very much end. So I will request you all to answer. There are a lot of questions that are coming. So we'll filter some of the questions for you. So Seychelles, one question for you is, which has come from one of our audience is, how can banks change their stance from being fair weather friend?
It's a very good question. When I joined banking, when I joined Citibank way back in the early 90s, I was taught that banks like to lend to people who don't need the money. So the ideal customer for a bank is somebody who actually doesn't want the money. Right? Now, banks by definition are custodians of public funds. Kashi mentioned the words, fiduciary. The banks have the ultimate fiduciary responsibility of ensuring that depositors' money is safe. Banks are not lending their money. They are lending depositors' money. So by definition, given the nature of their role, they have to protect the depositor's money. So if there is a customer, the environment has moved against him, the bank has to figure out whether more money needs to be given to that customer, whether that more money is actually throwing good money after bad, right? And very often, banks are unable to figure out the difference between a liquidity issue and a solvency issue. They are actually interlinked. A liquidity issue very soon becomes a solvency issue. And given the nature and the type of balance sheets and P&Ls that we provide in our country, it becomes very difficult for banks to figure out which is what is happening to the client. So if a client is having a liquidity problem, bank should give him a little bit more money so that he can get out of the liquidity problem, right? But if he's actually having a solvency problem, if the banks give him more money, the bank is only throwing good money after bad money. So banks are unable to figure out whether it is a liquidity issue or a solvency issue, and consequently, very often they make the wrong choice. For clients who are only experiencing a liquidity problem, they refuse to provide assistance. So they make both the type 1 error as well as the type 2 error. They end up providing liquidity where they should not, and they end up not giving liquidity where they should. So it is a necessary outcome of the role that a banker has to play, right? The banker's job is to protect the depositor first. So if you keep that in mind, you'll understand why bankers behave the way they do. I'm not saying that's the right way of doing it. There are other issues. Obviously the banker would like to help a customer, and if they had perfect foresight, they would be able to provide it. But we are working in imperfect information societies, and sometimes you have to make a call which may not be appropriate. I trust I've answered the question, Manish.
Sure, sir. Absolutely.
Just to add, this is a very interesting point. I mean, let's put ourselves in a place where there is a 65-year-old retired person who's put all his money in a particular bank, right? And your neighbor has started a restaurant which has borrowed money from the same bank, and he has his business is doing bad, and he is out there on the street. What would you expect your banker to do? Would you expect your banker to take all your life savings away and give it to that person? Would you call him a great bank? Would you respect that bank, or would you respect the other bank who safeguards your money? There is no right answer to this, but in essence, what Mr. Seshadri said, that this is this is part of part of our course in this business. Yeah, you have to be that way because that's the nature of your business, because you have to protect the depositor's money. And if you don't protect the depositor money, we have seen instances of banks going belly up, and what happens after that.
Absolutely right. Absolutely, I totally agree with the answer. So I'm changing a little bit of. There is a very interesting question which is coming up, which is how do you interpret the shift from fintech to techfin, where technology giants wants to enter in the banking domain? So we see Google starting Google Pay, Facebook, WhatsApp Pay, and there's a lot of these tech giants who are now trying to become into fintech and taking out on the banking domain. So Kashi sir, this question for you: how do you interpret this, and what may be the I don't know whether we should say what's the plan for the banks to safeguard their turf from the tech giants, or is it still the collaboration mode with these tech giants, or is it do you feel them as a threat right now?
See, it's the world is at an interesting precipice of fintech versus techfin, and we have seen, at least in China, we have seen a lot of techfin kind of be in the forefront of a lot of retail, finance and payments. We have Ant Financials and WeChat and all of other. These payment modes have become very significant. We have seen the rise of Google Pay and Amazon Pay, and Amazon wanting to come into banking, and all these things are definitely happening. And there are two things that we have to keep in mind, and we discussed that. One is the fiduciary responsibility that the banks have, and that places a huge amount of trust, and trust needs to be earned. Now, over time, banking as an industry has earned trust by doing a set of practices which are under regulation, time and again, demonstrated through tough times. Okay, there are banks which have gone belly up, but by and large, in the history, we have seen that banks have maintained their position of trust holders, right? Now that's very, very critical. When you say bank, the implicit in the word is the word trust, and therefore, okay, you can have various levels of trust. I trust bank A more than bank B, and therefore I will pledge my life savings to that bank. Please understand one thing. The difficult business is banking, which Mr. Seshadri knows, and which I also handle a big way, is raising money, raising deposits. That's where difficulty is, right? It is relatively easier to give loans because there are a lot of people with a arm asking for a loan. So the trust element in banking is a tough one to create. Now it remains to be seen. I'm not saying it's impossible. It remains to be seen whether the tech companies can parallel that trust. I'm not saying it's impossible. It's also possible that a huge change in technology such as blockchain or quantum computing and all of that stuff will deliver trust enabled through technology rather than process and regulation. Today, the trust is delivered by a set of process, regulation, and banks' own policies, and there is a framework in which it operates, and the public believes that. It's entirely possible that the transition through blockchain and other such technology can deliver the same trust through tech. If that were to happen, definitely the banks and the tech companies stand at equal footing. But by the time that were to happen, I can tell you bankers are not sitting quiet. They are also, doing their, rewiring and, stashing their whole tech stack and trying to get as nimble as possible. So I certainly think the tech fin will definitely operate in the carrier space. And when I say carrier means, there is a lot of open banking which is happening in the UK and the Europe. You have the PSD2 regulation which has come up, which gives access, permissioned access to your account information, which can help you to drive a lot of things. So I guess that large tech would come and occupy that space in terms of creating a layer where you can massage the customer data and give customers more. But the implicit element of trust, I would tend to think that for a long time would still remain with the bank. I could be wrong, but this is what I feel. It may take quite a few years, by which time I would tend to think the unfair advantage with the tech have today, the banks will catch up, because end of the day, tech is, it's all about investing time, money, and re-architecting the architecture. So the trust is the key differentiator, finally.
Thank you.
Manish, just to add what question Kashi said, I think even RBI is also, shown the path that there should be a restrictive banking licenses where payment banks and small finance banks, maybe there are many more RBI can bring in where specialization will be the key going forward at a banking system level. And everyone should not do everything is the kind of thing. And everyone should stick to their specializations and work more on that so that there is a better results which can come into the customers, all kind of customers. And that's something which is I'm hoping forward with regulators bringing in more and more initiatives from that side, and hopefully with that the fintech and the tech fin also will make sense in the long run to go.
So if I may add something, Manish, basically banks in India used to have 3 monopolies. The first monopoly was on savings. So we are the only institution that can actually legally accept savings. There are some deposit-taking NBFCs, but there are few, right? The second monopoly was on lending. Because of the way India is structured, only certain authorized entities can lend money. Now there are a lot of NBFCs, but there weren't that many in the past. So basically, there was a monopoly on lending. And third was a monopoly on the payment system itself. Right? If you remember, till quite recently, if you wanted to send money from Delhi from Bangalore to Delhi, you had to go get a demand draft, you had to mail it, and that other guy would have to bank it, and the whole process would take a week, right? So there's been a democratization of these monopolies, and these monopolies are slowly beginning to shrink. The one area where the monopoly is under most threat is the payment system. Because today you can move money 24/7. You can move it either through a bank or through some other institution. It is, and it's frictionless, right? The impact of this frictionless movement on the first monopoly, okay, which is basically savings, is a question that one needs to be answered. Can the flow of money be directed by these entities into other entities? So it was going to bank A, but because I'm using a payment system B, it is going into bank C because he's able to influence you and get you to move money somewhere else. And because the entire thing is costless and frictionless, that could actually happen. So from a bank's point of view, we are at a crossroad as to how to protect this monopoly that is given to us from the regulator, right? The fintech or tech fin or whatever you call them are in a position to disintermediate you there, and that is a big, big, big risk from a bank's perspective. Now, currently, I don't know how they make money. These tech fin or fintech and all that, I don't know whether they make money, whether there is spreads to be had, or whether it is merely burning somebody else's cash. I don't know. But having said that, right now the economics are not clear to me. But the economics on a cross-border, cross-currency basis are absolutely clear, because not in India, because in India banks have reduced FX margin to such a low level that there is nothing left there for other people to play on the basis of cost. But in other markets, FX margins continue to be relatively large, and there is a very significant play on the FX side. And their payment systems on a cross-border basis can actually make a lot of money and can disintermediate banks. But here, on a domestic basis, unless you have the capability to move savings out to preferred locations and then have a back-to-back deal with that entity to make some revenue, I don't see how this is going to work for the Texans. But from a bank's perspective, and I'm speaking as a banker, these are worrying trends because it reduces the last monopoly that we had as a regulated entity, right?
Very right, sir. There are a lot of questions that are coming up, but we have a shortage of time. So, what we may do is we will take these questions, ask our next eminent panelists to maybe answer some of them later on, and we will email it to the answers to these questions. But thanks, Seshadri sir, for coming here. Thanks, Kashi sir, for coming here. And thanks, Prasanna. This was really amazing discussion. I can see a lot of people saying this is a very great discussion. This is very good discussion, and a lot of people are asking for the recording of that. So thanks a lot for coming onto the panel, and thanks a lot for giving your knowledge and your views on banking and fintech to all our audience as well as to all of us at KredX. I think I was immensely get a lot of knowledge from this session. So thanks a lot for this. Thanks a lot for both all of you.